Hello and welcome to today's topic of discussion: the dark side of the stock market and how stock market manipulation works. The stock market, a place where millions of investors trade shares of public companies, is often viewed as a symbol of financial prosperity. However, there is a darker side to the stock market that is often hidden from plain sight: the practice of stock market manipulation. Stock market manipulation, place where companies and investors come together to buy and sell shares, can be a very lucrative investment opportunity, but it can also be a place where manipulation and fraud occur. In this video, we'll be delving deep into the ways stock market manipulation works and the consequences it has for everyday investors. Let's define stock market manipulation. It is an illegal and unethical practice where traders or stockbrokers artificially inflate or deflate the prices of a particular stock, often for personal gain. Manipulation can occur through various techniques such as spreading false information, engaging in insider trading, market rigging, and high-frequency trading. One example of stock market manipulation is pump and dump. This scheme involves buying a large number of shares of a stock, hyping it up by spreading false information or promoting it heavily, and then selling the shares when the price has gone up. This technique tricks investors into buying shares at a high price, which then plummet once the scammers dump their shares. Another type of manipulation is insider trading. This is where individuals with access to confidential information about a company use that information to buy or sell shares before the public gets the information. This can result in significant profits for the insider but can have detrimental effects on the overall market, as it can lead to mistrust and a lack of confidence in the market. Market rigging is also a popular technique used to manipulate the stock market. This is where a group of investors or traders artificially manipulate the supply and demand of a particular stock or securities in the market. By creating an artificial demand for a stock, they can buy it at a lower price and sell it for a higher price, earning significant profits. Finally, high-frequency trading, also known as flash trading, is a technique where traders use advanced algorithms and computer programs to analyze market data and make quick trades based on that information. This technique allows traders to make significant profits, but it also gives them an unfair advantage over traditional investors who don't have the same access to real-time market data. So, what are the consequences of these manipulations? For one, it can cause significant losses for everyday investors who may have bought shares at an inflated price or sold at a deflated price. It can also lead to mistrust and a lack of confidence in the market, which can ultimately harm the economy as a whole. Global platform for buying and selling stocks is often seen as a place where investors can make quick money. However, what most people don't realize is that the stock market can be manipulated by certain individuals and organizations, creating a dark and murky side to this seemingly innocent industry. Manipulation in the stock market is not a new phenomenon. It has been happening since the creation of stock markets and will continue that. There are groups and individuals who manipulate the stock market to their advantage, often at the expense of innocent investors. Essentially, it is the attempt to artificially influence the market price of specific stocks by creating false or misleading perceptions about the stock's value. This can be done in a number of ways, including spreading false rumors, issuing misleading press releases, and even creating fake social media accounts to promote or demote a particular stock. One common form of stock market manipulation is known as pump and dump. This involves artificially inflating the price of a stock, often by spreading rumors or buying up large quantities of the stock, and then quickly selling off the shares once the price has increased. This leaves innocent investors holding the bag and often results in significant financial loss for those investors. Another form of manipulation is known as short and distort. This involves short selling a stock, which involves borrowing shares of a company and selling them with the intention of buying them back at a lower price. However, those short sellers will then spread negative rumors or create negative press releases about the company in order to artificially drive down the stock price. The short sellers can then repurchase the shares at a lower price and profit off of the price drop. Stock market manipulation can also occur through insider trading. This is when individuals with access to privileged information about a company, such as executives or board members, use that information to make stock trades before it becomes public knowledge. This gives them an unfair advantage in the market and often results in significant financial gain. So what can be done to prevent stock market manipulation? The Securities and Exchange Commission, SEC, actively monitors and investigates potential cases of manipulation, and several laws and regulations exist to discourage this practice. However, it is still a prevalent issue in the market, and investors should always be cautious and do their own research before making any trades. In conclusion, stock market manipulation is a serious issue that harms investors and the economy as a whole. By understanding the various techniques used to manipulate the market, we can be more vigilant and make more informed investment decisions. We hope this video has shed light on the dark side of the stock market and the importance of maintaining ethical practices within the industry. Thanks for joining us today, and we'll see you in the next video.